Silver markets experienced the most dramatic volatility episode in recent history. Prices collapsed 40% in just 3 days. Silver dropped from over $100 to $72 per ounce. This wasn't gradual decline or normal market correction. This represented systematic destruction through forced liquidation that created artificial selling pressure. The speed of decline shocked even experienced precious metals traders. 40% price drops typically require weeks or months during normal market conditions. 3-day collapses of this magnitude suggest systematic intervention rather than organic supply-demand changes. Someone with massive capital deliberately drove prices lower through coordinated selling. However, the recovery proved equally dramatic. Strong buying emerged immediately after prices reached $72. Within days, silver recovered above $85. This rapid bounce indicates that fundamental demand remained strong, while the initial decline resulted from temporary technical factors rather than genuine weakness. The recovery pattern shows classic forced liquidation characteristics. When artificial selling pressure ends, prices snap back quickly toward fundamental value levels. Natural market corrections show gradual recovery over extended periods. Sharp bounces typically follow artificial price suppression through coordinated manipulation. Professional traders recognize these patterns because forced liquidation creates predictable price behavior. Initial panic selling overwhelms normal buying interest. Prices drop below fundamental support levels. Then value buyers emerge when artificial pressure subsides. Rapid recovery follows when normal supply-demand relationships resume functioning. The most shocking development occurred during the panic period. While retail investors sold in fear, institutional investors purchased $4 trillion worth of precious metals within 30 hours. This massive institutional buying occurred exactly when prices reached lowest levels and retail sentiment showed maximum pessimism. $4 trillion represents enormous capital deployment that requires coordination among multiple large institutions. Individual hedge funds or investment banks cannot deploy such amounts independently. This suggests systematic institutional coordination to accumulate precious metals during artificial price weakness created by forced liquidation. The timing reveals professional understanding of market manipulation mechanics. Institutional buyers knew that forced liquidation would create temporary buying opportunities at prices below fundamental value. They prepared capital in advance while waiting for optimal entry points that artificial selling would provide. Retail investors typically panic during rapid price declines while lacking understanding of manipulation dynamics. Fear drives selling exactly when professional buyers accumulate positions. This wealth transfer from retail to institutional investors occurs repeatedly during manipulated markets across different asset classes. The 30-hour time frame shows urgency in institutional accumulation. Professional buyers moved quickly to capture maximum quantities before prices recovered. This suggests recognition that buying opportunities at $70 silver would not persist once artificial selling pressure ended. Institutional coordination requires advanced planning and capital preparation that retail investors cannot match. Professional money managers maintain cash reserves specifically for such opportunities, while retail investors typically remain fully invested without available capital during crisis periods. The paper versus physical market disconnect became extreme during the price collapse. Futures markets showed $72 prices while physical silver became unavailable at any price in many markets. This disconnect reveals the artificial nature of paper price manipulation. Physical dealers reported empty inventory despite lower paper prices. Normal market relationships would show increased physical availability when prices decline. Instead, physical supplies disappeared while paper contracts traded at artificial low levels. This indicates systematic withdrawal of physical metal during price manipulation. Vault outflows accelerated during the price decline as investors demanded physical delivery rather than accepting cash settlement. Major storage facilities reported significant metal withdrawals, while paper markets continued showing weak prices. This physical demand created supply squeeze despite lower paper prices. The arbitrage opportunity between paper and physical markets attracted sophisticated buyers who could access physical metal at prices near paper markets. These buyers understood that physical scarcity would eventually force paper prices higher when manipulation ended. Delivery demands increased substantially as investors lost confidence in paper claims and demanded actual metal possession. Exchange warehouses faced unprecedented delivery requests while registered inventory declined rapidly. This physical demand pressure contributed to rapid price recovery once manipulation ended. Industrial users accelerated purchasing when prices reached artificial lows. Manufacturing companies requiring silver for production processes recognized opportunity to secure supplies at below-market prices. This industrial demand added pressure to limited physical supplies. China's precious metals accumulation extends far beyond official reporting through multiple channels that avoid public disclosure. Official central bank purchases represent only partial picture of total Chinese precious metals acquisition. State-owned enterprises, commercial banks, and private companies all participate in systematic accumulation. The strategic importance of gold pricing power drives Chinese policy toward precious metals dominance. Chinese leadership recognizes that countries controlling gold prices exercise significant monetary influence. This strategic objective justifies massive resource deployment toward precious metals accumulation regardless of short-term costs. Hidden accumulation occurs through Hong Kong trading, private mining company purchases, strategic reserve programs, and bilateral trade agreements that include precious metals components. These channels enable massive accumulation without triggering market concerns about Chinese buying pressure. State policy documents explicitly connect precious metals accumulation with currency strength objectives. Chinese monetary authorities view gold and silver as essential tools for eventual currency internationalization. This strategic framework justifies continued accumulation despite price volatility. Military applications provide additional justification for precious metals stockpiling. Silver's electronic properties make it essential for defense technology, including radar systems, missile guidance, and communication equipment. Strategic stockpiling serves both monetary and military objectives. Belt and Road Initiative projects increasingly incorporate precious metals, financing, and payment mechanisms. Infrastructure loans may include precious metals components, while trade agreements establish commodity exchange arrangements that build Chinese precious metals reserves through international commerce. Asian physical demand showed remarkable strength despite paper price weakness. Singapore and Hong Kong precious metals dealers reported unprecedented customer lines during the price decline. Asian investors understood that artificial price weakness created exceptional buying opportunities. Cultural factors contribute to Asian precious metals demand because gold and silver traditionally represent wealth storage across Asian societies. Economic uncertainty increases precious metals demand as families seek to preserve wealth through tangible assets independent from banking systems. Asian investors typically maintain longer-term perspectives compared to Western traders focused on short-term price movements. This patient approach enables accumulation during price weakness while avoiding panic selling during manipulated declines. Regional banking systems in Asia often provide precious metals services that facilitate physical accumulation. Asian banks typically offer allocated storage and trading services that Western banks increasingly avoid due to regulatory complications. Currency concerns drive Asian precious metals demand as regional currencies face pressure from dollar strength and domestic economic challenges. Precious metals provide currency-neutral wealth storage that maintains value across different monetary systems. Trade relationships between Asian countries increasingly incorporate precious metal settlements that reduce dollar dependency while building regional precious metals markets. These arrangements create systematic demand independent from Western paper markets. The U.S. government launched a $12 billion critical minerals stockpile program specifically targeting Chinese mining dominance. This strategic initiative demonstrates growing recognition that precious metals represent national security assets rather than simple commodity investments. Critical minerals designation includes silver alongside lithium, rare earth elements, and other materials essential for technology and defense applications. This classification elevates silver from commodity status to strategic resource requiring government stockpiling and supply chain security. The program aims to reduce American dependence on Chinese mining operations that currently dominate global precious metals production and processing. Strategic stockpiling provides supply security while supporting domestic mining development through guaranteed government purchases. Defense applications justify strategic stockpiling because silver's unique properties cannot be substituted in critical military technologies. Electronic warfare systems, advanced radar, and missile guidance all require silver components where alternatives compromise performance or reliability. Renewable energy goals create additional strategic demand because solar panel deployment requires substantial silver quantities while supporting energy independence objectives. Government stockpiling serves both defense and energy security purposes while reducing foreign supply dependence. The forced liquidation mechanics reveal systematic market manipulation rather than natural price discovery. Large financial institutions coordinated selling to trigger stop-loss orders and margin calls that created cascading downward pressure beyond what fundamental conditions justified. Algorithmic trading systems amplified the decline through momentum-following strategies that generated additional selling when prices broke technical support levels. These systematic programs operated independently from fundamental analysis while contributing to artificial price weakness. Margin calls forced leveraged investors to liquidate positions regardless of fundamental outlook or long-term investment merit. This mechanical selling occurred at precisely the worst possible timing while providing liquidity for institutional accumulation at attractive prices. The coordination suggests advanced planning by professional traders who understood that creating artificial price weakness would trigger retail panic and forced liquidation that would provide exceptional accumulation opportunities for prepared buyers with available capital. Recovery speed confirms artificial nature of the decline because genuine fundamental weakness would require extended periods for market healing. Rapid bounces typically follow manipulated declines when artificial pressure ends and normal supply-demand relationships resume. Professional manipulation creates predictable patterns that experienced traders recognize and exploit. Understanding these dynamics enables positioning for both artificial weakness and subsequent recovery, while avoiding emotional reactions that damage retail investor returns. Gold-silver ratio analysis shows silver trading at historically extreme undervaluation relative to gold. Current ratios exceed historical averages by substantial margins, while suggesting exceptional long-term value opportunity for silver relative to gold investments. Historical analysis reveals that extreme gold-silver ratios typically reverse through silver outperformance rather than gold weakness. Previous ratio extremes preceded major silver bull markets that substantially outperformed gold over multi-year periods. The mathematical relationship suggests silver prices must increase dramatically to restore normal historical ratios. Even modest ratio normalization would require silver prices substantially above current levels, while gold prices remained stable or increased moderately. Industrial demand changes contribute to ratio distortion because silver serves essential industrial functions, while gold remains primarily monetary. Growing industrial consumption creates permanent demand, increases that mathematical analysis suggests cannot be satisfied at current price relationships. Supply constraints affect silver more severely than gold because silver mining occurs primarily as byproduct of other metals. Dedicated silver mining represents minority of total production, while silver supply cannot respond rapidly to price increases through increased mining activity. The opportunity exists for investors who understand that extreme ratios create asymmetric risk-reward relationships. Silver positions offer substantial upside potential from ratio normalization, while downside risk remains limited by industrial demand support and supply constraints. Industrial demand growth creates permanent structural changes in silver markets that distinguish current conditions from previous cycles. Solar panel deployment, electric vehicle production, and electronics manufacturing all generate demand increases that operate independently from investment considerations. Solar industry growth requires silver for photovoltaic cell production, where alternatives reduce efficiency and long-term reliability. Global renewable energy targets create silver demand that government policies support regardless of price levels because environmental objectives override cost considerations. Electric vehicle adoption increases automotive silver consumption substantially compared to traditional gasoline vehicles. Battery management systems, charging infrastructure, and electronic components all require silver applications, where substitution compromises performance or safety. Electronics miniaturization increases silver content per device, while global electronics production continues expanding. Smartphones, computers, and communication equipment all incorporate silver components where alternatives cannot match electrical and thermal properties. Medical device applications utilize silver's antimicrobial properties for surgical instruments, hospital equipment, and implantable devices. Healthcare industry growth and safety standards create inelastic demand that continues regardless of price levels because patient safety cannot be compromised for cost considerations. Defense industry applications generate demand that operates independently from commercial considerations while prioritizing performance over cost optimization. Military procurement ensures continued silver demand for electronic warfare systems, missile guidance, and communication equipment regardless of price movements. Supply response limitations prevent rapid production increases when silver prices rise, because mining economics focus on primary metals rather than secondary silver recovery. New silver mines require years of development, while existing operations face declining ore grades and environmental restrictions. The physical shortage risk increases as industrial demand grows, while mining production remains constrained. Unlike investment demand that can decrease during higher prices, industrial consumption continues because production processes require silver properties that alternatives cannot provide. Inventory analysis shows declining above-ground silver stocks, while industrial consumption increases. The ratio of available inventory to annual consumption continues declining while creating potential supply crisis if demand growth continues at current rates without corresponding supply increases. Professional money management increasingly recognizes precious metals as essential portfolio components rather than speculative commodity positions. Institutional allocation toward physical metals reflects understanding that traditional financial assets face systematic risks during monetary system stress. The preference for physical over paper reflects growing recognition of counterparty risks in financial markets. Physical possession eliminates dependence on institutional promises while providing direct ownership of monetary assets that maintain value independently from financial system stability. Portfolio insurance concepts drive institutional precious metals allocation because traditional portfolio protection strategies may prove inadequate during systematic financial stress. Precious metals provide uncorrelated assets that maintain value when traditional diversification strategies fail. Long-term wealth preservation requires assets that maintain purchasing power across different economic and political environments. Physical precious metals offer this capability, while paper financial assets depend on institutional credibility and currency stability that may prove temporary. Strategic positioning by professional investors reflects recognition that current monetary and fiscal policies create long-term risks that require portfolio protection through assets independent from government policies and institutional performance. Risk management frameworks increasingly incorporate precious metals as essential components rather than optional diversification tools. When traditional asset correlations increase during crisis periods, precious metals provide portfolio stability that other alternatives cannot match. The wealth transfer from retail to institutional investors during manipulated markets demonstrates importance of understanding professional strategies rather than following emotional reactions to short-term price movements. Education about market manipulation mechanics enables better decision-making during volatile periods. Market structure analysis reveals systematic advantages that professional investors maintain through superior information, analytical capabilities, and capital resources. Understanding these advantages helps individual investors develop strategies that avoid becoming liquidity providers for institutional accumulation programs. This educational analysis examines observable market behavior and professional investment strategies rather than providing specific investment advice. Understanding these dynamics provides context for recognizing manipulation patterns while developing appropriate responses that serve individual financial objectives rather than institutional accumulation programs. The silver market episode demonstrates how artificial price weakness creates opportunities for prepared buyers while destroying unprepared investors through forced liquidation and emotional decision-making. Learning from these patterns helps develop investment approaches that benefit from market inefficiencies rather than becoming victims of systematic manipulation.